Onsdagen var en sur börsdag i både Stockholm och på internationella marknaden. Med oss för att diskutera marknad, klimat och framtid har vi Chris Watling, Global Economist, Chief Strategist with Longview in London and a frequent guest here in the studio. Good to have you here.
Nice to be here. Thanks for having me on.
And nice of you to come on such an interesting days. We're down a percentage when we record this. Tuesday was quite bad as well. Your thoughts on the turbulence we're in at the moment?
Well, we've got a bit of sort of Trump turbulence, haven't we?
Yeah.
And a Japanese bond market turbulence as well. Let's not forget, it's not just Greenland. I think it's spillover from what you're seeing in Japan with the 30 and 40-year bond yields spiking hard. And you do get a bit of spillover into treasuries on the back of that. So, but I personally wouldn't get too worried about it. I may have to eat my words, but I would have thought you want to buy dips. You know, I think this is a market that could do well in 2026.
It's not much of a dip yet, though. We're just a couple of percentage points down after a rather strong streak on markets. Any thoughts on timing?
Well, it's not a Liberation Day size dip, that's for sure. But markets, you know, have wobbles.
Liberation Day light, I would say.
I would say it's super light. Liberation, super light. Never mind light. But markets have small wobbles, and they're often triggered by events. And, you know, people were very bullish coming into this year. There was a very bullish narrative at the start of January, and for good reason too. But of course, market often gets a little bit ahead of itself and needs to clean out a bit. And actually, if you look at the S&P, it's basically flat on 2 or 3 months. It's just done nothing really for a couple of months. So it might need to consolidate a little bit more, give a little bit more back. But I would take advantage of any weakness over the coming week or 2 or 3 as an opportunity to put money to work, because the macro backdrop for 2026 is good. I mean, you know.
Yeah, we did come into the year with strong expectations of this year. And if that holds, obviously markets should go up. But a big but is that last time was once or first. Trump had a Liberation Day turbulence that scared everybody, and buying was a good lesson. Now, if it does it again, doesn't it change the dynamic? Doesn't it make all the negotiations of last year meaningless?
Well, potentially, but it depends on what you think his agenda is. I mean, it strikes me we've kind of seen the Trump playbook about 20 times now. We kind of know the story: go in hard, put everything on the table, shock and awe, and then roll it back, and you end up somewhere where you want to be if you're Donald Trump. And everyone else is like, oh gosh, it could have been worse. It wasn't so bad. So we're not going to have military conflict between America and Europe over Greenland. I would be staggered if that happened.
And I'm sure markets would be too.
And markets would be staggered as well. So this is classic Trump bluster at the start of a negotiation. And so I think it'll ebb out of the market's minds. You know, I think the Japanese bond stuff's a little bit more worrying, but again, the authorities have made the right noises overnight. So I think this, you know, the macro is good for this year. If you looked at the sort of macro indicators, it would suggest that volatility, believe it or not, should be pretty quiet this year.
Oh, wait, so 26 could be a quiet year in terms of volatility.
Quiet year for volatility. Clearly, geopolitical grenades thrown in can cause a little bit of upset. But actually, if you look at the underlying macro structure of the Western economy, it's in really good shape. One good way of thinking about volatility is as it's a basic measure of corporate sector risk. And if you look at the US corporate sector in aggregate, it looks great.
Yep. Net
debt to GDP is at 35-year lows. Free cash flow is good. Earnings growth is coming through. You know, you name it. So it should be a low volatility year. You know, it's a dangerous thing to put out there at the start of the year, but certainly that's what the macro would suggest.
Well, just point it out for clarity. Nobody knows what the future will bring. It's fun and stimulating to speculate still. But could we talk about? You mentioned Japanese bonds at the beginning of our discussion. Could we talk about something similar happening in the U.S. as a potential risk? There's a lot of debt, not in American corporations, but definitely on the government side.
I think that's definitely a risk, but I wouldn't put it down as a risk for this year. I think it's a risk in the next 5 to 10 years. When it triggers, very hard to know. I think for the last 15 years, that's been a topic of conversation. It's a bit like Iran blowing up the oil market. Every year someone says it's going to happen at the start of the year, and it rarely does.
Well, I think it's going to happen this year, as a matter of fact.
Yeah, well, there we go. You see, it's back on the table. Of course, it seems more likely this year. But of course, it could do the opposite in Iran. It may, you know, regime change may put more more oil into the market. The oil market's very well supplied already. But no, I think I do think the US bond market has a real challenge ahead of it in the next 5 to 10 years. But I don't think it's this year. We're cutting interest rates. The Fed is now buying bonds for reserve management purposes for their balance sheet. They're deregulating the banking system so the banks can buy more bonds. They did the Genius Act so the stable coins can buy more bonds. You know what I mean? It's a long old list. And I think I don't think we're going to see a blow up. Now, actually, if you look at US 10-year treasuries, they've gone sideways for 3 years.
They have indeed, but yesterday there was, I don't know if you picked it up, there was a small Danish pension fund saying we will not buy our own American bonds anymore. That's nothing, of course, unless we, the Swedes, maybe in the Netherlands, other countries in Europe would start doing the same. There's a risk of a real effect here. It's not.
Well, there's always a risk of that. But again, I mean, people, for as long as I've done this job, people have said, well, what happens if these guys don't buy anymore? Surely there's who's going to buy? And one never knows. The reality is the price decides who buys when it's attractive. And to be fair, I mean, it's interesting to read about the Danish pension fund, but their position size was $100 million, which is sort of chump change. But no, I mean, of course it could snowball, and I think it will snowball. I think that's why the dollar will be weak, because the American exceptionalism is kind of done. We kind of know that. Trump's putting nails in the coffin of that one. So people need to diversify global portfolios away from the US more.
And that's an interesting point. But it is unusual. We have a risk-off in the markets with a weakening dollar. That's not the usual.
That's not normal. That's quite right. And I think that probably speaks either the Japanese bond correlation with the US Treasuries, or maybe it's Trump's geopolitics. But it is unusual. And I would have thought this year you're more likely to get risk off with Treasuries rallying, because inflation's beaten. And therefore, it's, the last few years, risk parity hasn't worked because everyone's worried about the inflation flare up. Now I think inflation's probably beaten, so it should go the other way. So that was interesting. I agree.
So no sell America when it comes to owning bonds, but a bit of a, all right, let's put some money out of the US on the equity side and find opportunities elsewhere. Is that what we're...
Well, bonds as well. I mean, people are selling US assets, I think, in general, because they're worried about the new world order that's developing under Donald Trump. So, yes, US assets get sold, equities included. And yeah, I mean, also, I think it's more sort of macro driven as well, in that we're going to get a global cyclical recovery in 2026. And therefore, US assets are very growth specific, less cyclically sensitive. Other parts of the world are more cyclically sensitive, like European equity markets. So I think they can do well over the course of this year as a result. So you get allocation away from, everyone's crowded into US growth. In the last 6 months, we started to see that diversifying away, but that takes a long time, but that's dollar negative.
All right, we're taking some money out of the US, out of Wall Street, and perhaps put it in European equities. How about commodities? Do you follow those?
Yeah.
Oil is flat and gold is booming.
Love commodities. I mean, I think we're in a commodity super cycle.
What does that mean?
What does it mean?
They go up.
It means a sustained uptrend for many, many years, not just a sort of 1 or 2 year story, a multi-year story. So the last super cycle you remember was 2000, 2012. The one before that was the 1970s. And I think we can have another one. And it started with gold, and it's now, I think, going to morph into industrial base metals and then eventually into energy. I wouldn't buy oil today. There's far too much oil in the world. But we have been buying copper. And I think gold, I know it keeps making new highs, but I think it's largely done.
Has it become
now, anyway?
Has it become more of a Bitcoin thing, more of a speculative asset than a real?
Well, it's not behaving like a sort of safe haven, is it? It's behaving like a sort of, in the last 3 years, it's up more than the S&P, which is kind of troubling. So yeah, gold's doing what it always does. It prices in the need for monetary easing and a bit of geopolitical risk. And I think the need for monetary easing, a lot of that's in the curve. So gold's done its job.
We're recording this conversation just minutes before Donald Trump goes on in Davos. Davos is obviously a big meeting for a lot of big people. Does Davos matter for markets more than usually this time around?
Well, Trump's speech might well matter for markets. I think Davos generally doesn't matter for markets. It's often a good contrarian indicator. I remember famously one great well-known hedge fund manager telling us that cash is trash in January 2023, just ahead of the terrible year for US equity markets. So yeah, I think Davos is a good contrarian, because whenever a lot of people get together in a room and agree on something, it's generally in the price, even if they're super clever and the elite. But I do think Trump's speech will be important.
All right, last question then. At the beginning of the year, every intelligent market analyst and strategist gathered together and put out prognoses of stock markets going up in 2026.
Yeah.
A little bit too much concentration in the same lane, if you ask me. Should I be worried about that?
It's the same article every year, so no. It doesn't tell you anything. Some years it'll be right, some years it won't.
All right. But still, I'll allocate out of the US and I'll buy the dip the next couple of weeks, essentially, if there's more dip to come.
Keep buying dips. We're mid-cycle, not the end of the cycle. So the stock market should trend up globally. Cyclicals should do well over the course of the year. I suspect in the first half of the year, tech will have a bit of an upside flurry, but don't fall in love with it. Just trade it. And then, markets should do well. The industrial global recovery is happening and coming, and 26 and 27 should be good years.
Chris Watling, wonderful to have you with us always. Glad to have some optimism in the studio on a gloomy day like this.
Great. Thank you. Appreciate it.
Thank you.
Thank you.